Hey, welcome to another episode of Ace Your Exams with InsuranceTestHelp.com. Today we're going into the Series 6 exam for people that are going to sell annuities, mutual funds, and this is going to be a practice quiz to see if you're ready for the test. Series 6 is super comprehensive, but super short. So, it's a little bit, there's some overlap between the Series 6 and the SIE. So go back and look through your SIE stuff. Trust me, it's going to help. But also just be really prepared because every question on the Series 6 is heavily weighted because the test is so short. It would be better if it was more like 120 or 150 questions. Each one wouldn't mean so much, but each one is pretty impactful to your score. So just go back and check through them and make sure you're ready to go before you go take it. So here we go. First up, what is the primary purpose of the assumed interest rate, AIR, in a variable annuity? A, to guarantee a minimum return on investment. B, to determine the number of annuity units. C, to establish a benchmark for adjusting future payouts. Or D, to calculate the maximum annual payout. Pick one. So correct answer is going to be C, to establish a benchmark for adjusting future payouts. AIR is used to put the payout up or down depending on what the assumed interest rate is and how you're being paid out on that. So if your AIR is up, your payment's going to go up. So just something to keep in mind in knowing exactly what AIR is and what it does, okay? Okay, which of the following statements is true regarding variable annuities? A, payments are guaranteed to never decrease once annuitized. B, investment performance directly impacts the payout amount. C, the number of annuity units fluctuates monthly based on returns. Or D, variable annuities offer fixed monthly payments. Which one? This is a variable annuity, so investment performance directly impacts the payout amount. Remember, there's a separate account. That's where your investment performance is. The person that has the annuity assumes all of the investment risk of that separate account. So based on the performance of it, your payout's going to go up or down. What is the primary purpose of the Customer Identification Program, CIP, required by FinCEN? A, to monitor transactions over $10,000. B, to verify the identity of customers opening new accounts. C, to detect and report unusual account activity. Or D, to provide tax identification numbers to customers. So I feel like this is one where you could actually see this on the exam. It's going to have a couple that sound kind of right, and then a couple that are really, really wrong. So the correct answer is B, to verify the identity of the customers opening new accounts. That's where you need their name, address, social security number, and you need to verify that they have a photo ID. Which of the following would be considered structuring, requiring the filing of a suspicious activity report, SAR? A, a client makes a one-time $15,000 cash deposit. B, a client wires $25,000 to a foreign bank in a single transaction. C, a client repeatedly deposits $9,000 in cash over several days to avoid reporting thresholds. Or D, a client withdraws $5,000 for personal use. So the answer is C, a client repeatedly deposits $9,000 in cash over several days to avoid reporting thresholds. Remember, in the question it was looking for structuring. So there's different parts of money laundering. There's layering, there's structuring. Structuring is making little deposits and moving things around to avoid. So just make sure you understand exactly what structuring, layering, and all the different parts of the AML are, okay? What is the primary tax advantage of a Roth IRA? A, tax-deductible contribution. B, tax-free growth and qualified withdrawals. C, tax-deferred growth. Or D, no penalties for early withdrawals of earnings. The answer is going to be B, tax-free growth and qualified withdrawals. Remember, the Roth is a beautiful thing. You put it in with your after-tax money, and then it grows tax-free, and when you take it out, as long as you are over 59 and a half, it is also qualified withdrawals. So just spouting the wonderfulness of the Roth. But be sure you know the difference between a Roth and a traditional IRA, because there's probably going to be at least one question on those. Which of the following is a qualified reason to make an early withdrawal from a traditional IRA without incurring the 10% penalty? Remember, you're still going to pay income tax, but you're not going to pay that extra 10% penalty. Is it A, to purchase a new car, B, to pay for higher education expenses, C, to pay for a vacation, or D, to invest in stocks outside the IRA? So it's going to be B, to pay for higher education expenses. That is one of the things that you are allowed to withdraw from your IRA without taking the penalty. You will still pay the income tax, but you won't incur the 10% additional penalty like you would if you were just taking it out to do any of those other things on the list. Which of the following is not required on Form U4? A, employment history. B, residential history for the past 10 years. C, education background, or D, criminal disclosures. You better know all the things that your U4 and U5 do. Those are really critical. If you don't know, go back and do some reading because it's really important. There'll be more questions on the U4 and U5 than you would expect. So correct answer here is C, education background. FINRA don't care where you went to school. They just want to know if you're a criminal and where you lived and what you've been doing for the last 20 years. So just make sure you know all of the things you need to put on your U4. An RR guarantees a customer will not lose money on an investment. This practice is A, allowed with written disclosure, B, prohibited under all circumstances, C, allowed for accredited investors, or D, allowed with a verbal agreement. You better know this one because this one's pretty basic. Prohibited under all circumstances. B is the correct answer. Anything. There's no using the word guarantee. You cannot guarantee the SEC approved it. You cannot guarantee that you got approval from the state. You cannot guarantee that you got approval from FINRA. And you certainly can't guarantee that a customer is going to make money or not lose money or anything of any kind like that. So no guarantees. Yeah, it's investing. What does current yield measure? A, annual income divided by market price. B, total annual income divided by par value, C, total return on an investment, or D, income and capital gains combined. Be sure you know your bond yields. Not going to get a lot of questions on them, but every question is going to count, so know what all of the different bond yields are. Current yield is going to be A, annual income divided by market price. That gets you your current yield, what it's going for right now. What is the primary benefit of writing covered calls? A, unlimited profit potential. B, increased portfolio diversification. C, additional income through premiums. Or D, guaranteed capital appreciation. C, additional income through premiums. Remember, they are covered calls, so you're not going to lose a whole ton of money if, for some reason the option is exercised. So I don't know how many questions you're going to see on options. You probably had to know a bit more about options for the SIE, and even then I think it was like 1 or 2 questions maybe. The Series 6 you may get 0, you may get 1, you may get 2, I don't know. Depends on what option they give you, but I would know the basics of options just because you don't want to give any questions away. What does the term bid price refer to? A, the price a seller is willing to accept. B, the price a buyer is willing to pay. C, the price set by the market maker. Or D, the final transaction price. So remember, bid is the price a buyer is willing to pay. Ask is what a seller is willing to sell it to you for, because they're asking that price. So just remember that bid, buyer, ask, seller. A customer buys a call option with a strike price of $50 and pays a $5 premium. What is the break-even price? A, $45, B, $50, C, $55, or D, $60. The correct answer here is going to be C, $55. The $50 plus the premium price of $5 gets you the break-even price. Again, this is the basics of options. I would know how to do all the basics. What is the relationship between bond prices and yields? A, they move in the same direction. B, they move in opposite directions. C, they are independent of each other. Or D, they are inversely related only for municipal bonds. So the correct answer here is B, they move in opposite directions. So I don't want to scare you with trick questions. Obviously, the put the inverse relationship in there was a little bit to throw a curveball. And I feel like there will be a couple questions on your Series 6 exam where they may be trying to get you with some curveballs. So just read the full question and really pick. There's going to be 2 answers that maybe sound right, and there's going to be one that really sounds awesome, and then 2 that kind of don't sound right at all. So make sure you're reading the full question and reading all the answer choices. A mutual fund's expense ratio is defined as A, annual operating expenses divided by the fund's NAV, B, the load percentage charged to investors, C, management fees divided by average daily volume, or D, annual returns minus operating expenses. Correct answer here is going to be A, annual operating expenses divided by the fund's NAV. So be sure you know all about NAV. The test being for variables and mutual funds is going to be really heavy into things regarding variables and mutual funds. Be a lot of suitability questions, but there's going to be an awful lot about the details of how mutual funds work. Okay, so just make sure you know a lot of these little tidbits because you don't want to miss a question on something really basic like this. What is the penalty for failing to disclose a felony conviction on Form U4? Remember I told you to know everything about your U4? A, $10,000 fine. B, immediate suspension from the securities industry. C, permanent disqualification from association with a member firm. Or D, a written warning from FINRA. Correct answer here is going to be C, permanent disqualification from association with a member firm. Lying on your U4 is much worse than having the felony in the first place. So you have to disclose all of your stuff on your U4. And if you go on Broker Check, you will see people that have a lot of stuff that you're like, wow, who knew? But they've disclosed it, and that's what you have to do. So everything on your U4 is just an honest disclosure. So any questions about not disclosing something, err on the side of caution, disclose everything. The record date for a dividend is A, the date on which the board declares the dividend, B, the date on which shareholders must own the stock to receive the dividend, C, the date the dividend is paid, or D, the date the stock being traded trades ex-dividend. Correct answer here is going to be B, the date on which the shareholders must own the stock to receive the dividend. Remember your DERP acronym from the SIE, Declaration, Ex-Dividend, Record Date, Payment Date. That is a acronym that is good to remember all the way through your testing journey. Which payout option provides the highest initial monthly payment but stops payments upon the death of the annuitant? A, life only, B, life with period certain, C, joint and survivor, or D, refund life. It's going to be A, life only, because the risk is all on the annuitant. They could die a week after they annuitize. They could die 40 years after they annuitize. So it's really all up to the risk is all on the annuitant. That makes it the highest payment, but as soon as you die, that's it, even if you only got payments for 2 months. What is the term for the phase when the contract owner contributes to the annuity and earnings accumulate tax deferred? A, distribution phase, B, accumulation phase, C, annuitization phase, or D, payout phase. So the correct answer is going to be B, accumulation phase. Remember, you are accumulating money into the annuity, and then when you annuitize it, it pays out. So the putting in, where it grows tax deferred, is the accumulation phase. What is the required time frame for filing a suspicious activity report, SAR, after detecting suspicious activity? A, within 24 hours, B, within 5 calendar days, C, within 15 calendar days, or D, within 30 calendar days? Correct answer here is going to be D, within 30 calendar days. I know it seems like forever. It does seem to me like a long time, like almost like it's not suspicious anymore because it's so old, but that's the law. So 30 days is how long you have to file a suspicious activity report. And just make sure that you kind of know those ones that are time specific like that. Which of the following is true regarding required minimum distributions, RMDs? A, Roth IRAs and traditional IRAs both require RMDs beginning at age 73. B, Roth IRAs require RMDs, traditional IRAs do not. C, traditional IRAs require RMDs beginning at age 73, but Roth IRAs do not require RMDs during the owner's lifetime. Or D, neither Roth IRAs nor traditional IRAs require RMDs. So the correct answer is C, traditional IRAs require RMDs beginning at age 73. A Roth IRA does not require RMDs during the owner's lifetime because it's all money you put in after tax. So the Roth was your after-tax money. The traditional IRA was your before-tax money. So that one, they're going to get their tax money from you, and you're going to start paying it at age 73, whether you want to or not. And that is one of the ones where I would know that exact age. Know your no penalties after 59 and a half, and know your age 73. Those are both critical sort of ages to know. Which of the following is a feature of a 529 plan? A, contributions are tax deductible. B, withdrawals for qualified expenses are tax-free. C, there are no penalties for non-education withdrawals. Or D, contributions are subject to annual tax filings. The correct answer here is going to be B, withdrawals for qualified expenses are tax-free. 529s are a beautiful thing. All of those education expenses can be paid for by withdrawing, and there are no taxation on it. But if you took it out to buy Junior a car, then guess what? You're going to pay a whole bunch of tax on it. So just remember that withdrawals for education expenses, that includes computers, room and board, those things are all qualified expenses. Those are all tax-free for 529s. SIPC coverage provides protection for A, market losses due to bad investments, B, bank accounts in the event of bankruptcy, C, securities and cash in a brokerage account up to $500,000, D, mutual funds that perform poorly. So the SIPC is set up to help you in case your broker or dealer went bankrupt and didn't have the money to give you what was sitting in your brokerage account. So that is $500,000, $250,000 of which can be cash. So the rest of it obviously would have to be securities to get up to the $500,000. Know that all accounts are treated separately. So if you had your own personal account, you and your wife had a joint account, that's 2 accounts. But that is what SIPC does. It protects you in the event that there is an insolvency at your broker-dealer. It certainly doesn't provide for bad investments. It doesn't protect bank accounts. That's the FDIC. And I feel like there could be a tricky question with that kind of wording on there. So just remember what it does. Which of the following is not considered a type of investment company under the Investment Company Act of 1940? A, unit investment trust. B, face amount certificate company. C, real estate investment trust. Or D, management company. The correct answer here is going to be C, real estate investment trust. Remember, this was an except question, so all of the other things were correct except for this one. So just make sure that you know what 3 things are considered to be investment companies in the 1940 Act. Which of the following is true about municipal bonds? A, they are risk-free. B, their interest is always taxable. C, their interest is generally exempt from federal income tax. or D, they are backed by the U.S. government. Correct answer here is going to be C, their interest is generally exempt from federal income tax. Obviously, munis are not backed by the U.S. government. So take some of the questions and just put them out there as goofy. And I think you can kind of figure out, what the right answers are. So tax-free from federal income tax. A couple in their early 60s wants tax-free income and plans to retire in a few years. Which investment is most suitable? A, REIT, B, municipal bond fund, C, growth mutual fund, or D, high yield bond fund. So this is going to be a suitability question. There are going to be several suitability questions. They're probably going to be more complex than this, but you need to have an idea on what customer is good for growth funds, what customer is good for target funds, what customer is good for bond funds, and just make sure that you understand how their age and their risk and their goals and their time horizon affect all of the things that they might be investing in. The correct answer here is going to be B, municipal bond fund. The key phrase in the suitability was that they were looking for tax-free income. So income screams bond, tax-free screams municipal bond. So people as they get older tend to be looking for more income. The other one in their thing was that they're retiring in a couple of years. So pick up on all of those things in the question: their age, their risk tolerance, their time horizon, and their goals. A young investor wants high returns and is not concerned about short-term volatility. Which of the following is most suitable? A, large cap value fund, B, target date 2025 fund, C, small cap growth fund, or D, bond ladder. So correct answer here is going to be small cap growth fund. He is not concerned about volatility. He's very young, got a really long time horizon, looking for growth. So he has a high risk tolerance because he doesn't care about volatility. And so you're going to pick one that matches him. So this is, in his case, it's going to be C, the small cap growth fund. A registered rep sends a tweet recommending a mutual fund. What must occur? A, nothing. Social media is not regulated. B, pre-approval by a principal. C, post-approval within 10 days. Or D, only FINRA approval is required. B, you're going to need pre-approval by a principal to go recommending things on social media. So just make sure you know the rules for communication. What does reinvestment risk most directly apply to? A, stocks, B, mutual funds, C, callable bonds, or D, options. Out of that list, the one that makes the most sense is C, callable bonds. You have a call protection period, but then it can be called, and they will call it if it makes sense for them to get rid of it and get a different rate. That is one where your reinvestment risk, your money would be coming out of it maybe not at the best time for you to reinvestment, making it reinvestment risk. What document outlines the rules and investment objectives of a mutual fund? A, Form ADV, B, investment policy statement, C, the statement of additional information, or D, the prospectus. The answer here is going to be D, the prospectus. That's where all the good info is. Just know what prospectuses do, both for stocks as well as for mutual funds. The breakpoint schedule in mutual funds refers to A, the rate at which dividends are paid, B, the period in which the NAV changes, C, the discounts for larger purchases, or D, the redemption fee schedule. The answer here is going to be C, the discount for larger purchases. Remember, breakpoints are spaces where the commission would go down as you invested more money. So if you invested, say, $10,000, you would pay a higher commission percentage than you would if you did $100,000. So there's a schedule all the way up showing what the breakpoints are, so customers can know what they would need to invest in order to get those lower rates. A letter of intent allows an investor to purchase mutual fund shares at a discount by committing to buy a certain amount over time. B, defer paying capital gains taxes on mutual fund earnings. C, avoid sales charges on mutual funds if they hold them for 5 years. Or D, transfer shares to another family member without incurring taxes. This one goes with the previous one with breakpoints, so you should know what an LOI is, so take a guess. So a letter of intent allows you to A, purchase mutual fund shares at a discount by committing to buy them over a certain period of time. So you can, a letter of intent is non-binding. If you don't meet that level, then they just charge you the other rate that you were supposed to pay. So there's no harm in giving them one if you think you're going to be at that. One of the prohibited actions that goes with it is breakpoint selling. That would be selling right below the breakpoint to get that higher percentage of commission. That is a prohibited act. Just know that for letters of intent, you can backdate them 90 days and they can last for as long as 13 months. So just keep in mind all of the things with breakpoints, good. Letters of intent, good. Breakpoint selling, not good, prohibited. And all of them kind of go together. An RIT must distribute at least what percentage of its taxable income to shareholders? A, 50%, B, 60%, C, 75%, or D, 90%. I'm not sure how many questions you're going to get on REITs, but I would know the basics of them. Correct answer here is they have to distribute 90% of them to their shareholders. A 12B1 fee in a mutual fund is primarily used to cover A, portfolio management fees, B, distribution and marketing expenses, C, administrative and legal costs, or D, tax liabilities. Correct answer here is B, distribution and marketing expenses. That is generally what they cover. They are an add-on. I would know what they are and what they do, because anything to do with mutual funds is going to probably be on your test. Mutual fund companies must calculate the NAV of their funds, A, once a month, B, twice a day, C, once a day, D, every time the stock market changes significantly. So I would definitely know this. The correct answer is once a day. NAV is calculated at the closing of the stock exchange, and I would know that it is forward pricing. So if you bought mutual fund today, the price that would be calculated at is not yesterday, it's today. So if you bought it at 2 p.m. in the afternoon, they won't know the price until the market closes later on. So, and I would know exactly what time the market closes. I would know it's Eastern time, and I would know exactly that that's when NAV is calculated, because there could be a question, just a weird, bizarre question about that on your exam. A closed-end fund share price is determined by A, net asset value, the NAV, B, market supply and demand, C, both NAV and management fees, or D, the 12B1 fees charged. Key wording in there was closed-end fund. Closed-end funds are determined by B, the market supply and demand, as they are traded in the secondary market. You cannot trade them with your Series 6, but you may get a question on them. You have to know the difference between your open-end and your closed-end funds. If you don't, we have quite a bit in our other videos on the Series 6, so maybe give those a check out if you struggled with it. So we're at the end. We wish you very best of luck on your exam. If you were struggling with anything, please check out our other videos on the Series 6. We hope they help you. We hope you get the pass first time go around. And if you have any questions, comments, or suggestions, we'd love to hear them. Thanks. See you next time.